So briefly, I will keep it brief, just to be short. I have 10 minutes, but I'm also of course, meant to time keep. But if I talk too long, please remind me in this setting. So I think this directive, which we are going to discuss, I myself, while thinking about it in the train, think I've quite some first-hand experience with it. The first moment I experienced how this kind of directives work about prudential regulation of investment firms was when I was litigating on behalf of a group of private clients, and they all lost money because of the Madoff scandal. And at that time, we wanted, of course, to litigate against the investment advisor, but the investment advisor was not prudent, to be honest. So there was no money to go after. So if you think about prudential regulation of investment firms, that's one of the reasons, I would assume. Secondly, at a later moment, and then we come more into the scope of this directive and regulation we are going to discuss, I worked at an asset manager, and then you find out, that was at the time when CRD4 was to be implemented, that an asset manager was also subject to this. At that time, that was a reason for this specific asset manager to move a little bit into a different regime, the UCITS AFMD regime. Later on, and that is talking about 2016 already, I worked with a really small asset manager, but which did held client funds and assets. Because that time it was Prudential, had only 50 million assets under management, it was a fintech, but nevertheless you're subject to CRD, CRR. So you experience over time that there are all different angles to this kind of regulation. At least that's what I experienced. If we briefly go over what is the proposal about, we will do it briefly. I assume that most of you did have time to read it, but for those of you who would like to have a brief refresher. Well, basically the proposal distinguishes between three kinds of investment firms, and the idea being that you have the class 1, and those are the really big bank-like investment firms, and they will become most heavily regulated. Then you have class 2, those are non-systemic investment firms, but which nevertheless do have some importance for the financial system as a whole. And class 3, and those are the smallest and non-interconnected firms, which are subject to really simple requirements. And if we're talking about those classes, this is what they aim to achieve. If you look at what's the difference, like the bank-like, the class 1 investment firms, they will be treated as banks. So I think we won't discuss them in detail now, because basically the idea is that they will be covered by the current CRR and CRD4 as they are standing, and any follow-ups on those regulations and directives. But we will zoom in more into the other ones. And here you see, for example, class 2, a little difference. They, as far as governance and remuneration is concerned, they are more heavily regulated than class 3 firms. They are less heavily regulated than banks, but more heavily regulated than class 3 firms. Also, you see that there are still some disclosures which are quite similar to the banking disclosures, but lighter under the Pillar 3 Basel system. You have liquidity requirements. It's also, I think, an important, rather new thing. And what you see here is that at least 1/3 of the fixed overhead should be held in liquid assets to be further defined. And you see once more a little bit of a difference, whereas the class 3 firms are treated a little bit lighter, in the sense that they can also include receivables in their liquid assets ratio. And then I think something which will be heavily discussed today, which I would assume, and those are the K factors. And the idea behind these factors is to basically to calculate the risk that an investment firm is bringing either to itself, its clients, or the financial markets. Here you see the definitions, and you see has been distinguished between, well, basically risk to customers. So the idea being that by operating an investment firm, you create risks for customers because of what you do for customers, and these are meant to be the main risks. So here you see one of the risks is that if you have assets under management, if you hold client money, if you administer client assets, financial instruments, or if you execute trades, if you handle orders for clients. The idea being that all these K factors, these activities lead to risk, and therefore they need to be brought into the equation. This is for the customers. Then you see risk to markets. That is something probably also be heavily discussed today. No. So you see here, that is one is called net position risk. So that is quite familiar. That is also in CR, CRD. That you calculate basically the risk based on more mathematical approach. And the other one is the clearing market guarantee, the idea, the clearing member guarantee, the idea that to the extent that you have margin with the clearing member, that is the risk you are in fact facing for the market. And the risk to the investment firm itself, the idea being that the investment firm can also be, get risks in from the wider market. For example, if a trading counterparty defaults, or if another large exposure counterparty defaults. I think those are the main, that's the K factors. So the idea is, again and again, to basically to determine what the risk is, which capital should be held against. And this is the timeline, I think, but maybe, I don't know if this is still the relevant timeline. This is the timeline when I made this in April. But perhaps other people know more. So,
probably at some point.
probably you know. Okay, so that is for my introduction.